So let me start today's lecture. So in the last Wednesday, that day was our university anniversary. So you didn't have to come to the class, and actually many of you were not in the classroom. But anyway, we did our study, and we have finished chapter 0 and also the first part of the chapter 1. So what we learned in the last class is first, I wanted to make sure that we are on the same point of view. So we talked about what's financial analysis and what's the fundamental point of view that you need to have. And secondly, in chapter 1, in the first part, we talked about financial statements. We learned about the basic financial statements like balance sheets, the income statement, and cash flow statements. And then we learned how they are structured and how we can derive information out of there. And today we are going to study the second part of this chapter, which is the value problems. So basically, financial statements are written in the language of accountants, and they are accounting information. However, your point of view as an accountant, or your point of view as an economist, or from the area of the finance is totally different. So sometimes you need to understand that although we are using financial accounting information, we need to be careful in interpreting these results. So that's what I'm going to talk about in this section. So we are going to discuss several limitations that financial statements have, and then we are going to know how we need to approach or how we need to overcome these limitations. So the value problems, this is not a official term, but I'm going to use it because the textbook is also using the same term. So the value problems in this textbook is that financial statements sometimes do not reflect the economic reality, the actual situations, what is happening in real world. So there are two kinds of value problems that we are particularly interested in. They are market value versus book value situation. And the second one is whether we need to recognize something as an income or not. So it is different if you are an accountant, and it is different if you are studying finance. Okay, first, we need to understand the difference between market values and book values. All right, so basically, the words or the numbers written in the financial statements, they are called book value because they are written on a book. And it is an item recognized by the accounting principles. But one thing that I'd like to say is that accounting principles, they are very conservative in a sense that they do not reflect fluctuating changes, what is happening in a relatively short period of time. So let's say that let's say that I was able to buy real estate 10 years ago. Say I was able to buy a 2-floor building in Gangnam State. And I will be very happy because right now the price is skyrocketing. So for example, let's say I bought it 10 years ago at the price of 1 billion Korean won. And then now it is 30 Korean billion won right now. So I'm making a lot of profit by purchasing this building 10 years ago. But the problem is, from the point of view of accountant, you did not make any income if you are still holding this building because you recognize the value of this building when you purchase this building, but you would not change or you would not modify the value written on your book. So basically, in most of cases, these accounting items will be recognized at when you make a transactions. It will be measured as the original cost, and you will not change it for anything until you sell it to someone else. So that's the problem. And in that case, it is really different from the reality because I'm making fortune by buying and selling this building or real estate, but it is not reflected on your balance sheet. So therefore, we need to think what will be the market price. I'm not saying that the market price is the fair price. So there's a term fair price. So the fair price is the idealistic price for an item. However, because you are not a god and you are just a human, you don't know what will happen in the future, and at the same time, you don't have all the information you need, so you cannot know the fair value directly. However, one way to estimate it or one way to get a closer approximation is to rely on the market transactions. Because in the market, there are a lot of people making transactions, buying and selling those items similar to your item, so that you can learn from others what others are thinking about the value, the true value of this item. And then you will realize that eventually, because of the principle, because of the supply and the demand principle in economics, more people buy and sell, more it will approach to the fair value. So eventually, the market value will be very good approximation to the fair value. So that's why we often try to use the market value rather than relying on the book value. So it is okay we rely on the book value of the item written in the financial statements because these are these are the things that we can use. However, at the same time, you need to understand that okay, this is book value, so actual market price can be different. So that's what we want to learn from this part. And the second, so as an example. So let me show you the company's values in the United States. So this textbook selected some recognized companies for different industries. For example, you have Google. Here it is written as Alphabet because the Alphabet is the mother company of the Google. And you have Coca-Cola, Delta Airlines, which are the symbols in their own industries. And in the second column, you have the book value. So the book value of this equity, this is written in the balance sheet. So these are the inputs made by the shareholders when initially they founded company or when they initially invested to those companies. So it does not reflect the current changes or the estimation about the future. On the contrary, you have the market value of equity here, which is really, really large compared to the book value. Yes, do you have a question?
Yeah, like when you see the market value and book value, like the book value is like lower, is it because of depreciation? Is it because of the depreciation?
Can you say it again?
Differentiation.
Differentiation?
Yeah.
Differentiation for Depreciation. No, that's a different story. So the book value is okay. So let me give you an example here. So let's just say so the book value of equity will be given like this. So let's say you have your own company and there are 1,000 shareholders. Sorry. 1,000 shareholders, each holding a share, and the initial price of the stock was $10, and then you can multiply it. So the initial input to the company is $10,000. So it will be recorded as the shareholders' equity for the first balance sheet they have. And as time goes by, you will make some income, and then you will add some of the income to this shareholders' equity, so that it could be $10,500 if you earned $500 this year. Okay, so this is how the book value of equity works. But the market price of equity over there is different. So let's say that someone among those 1,000 shareholders, someone sold his share or her share at the market, at the stock market, and he sold the stock at $100. So this is the market price of the stock, because it is transferred from someone to the other at this price in the market. And then if this is the latest trading, then you will consider it as the latest market price. So you will regard the value of each stock as $100. So basically, we estimate the market value of equity by multiplying the number of shares and the current market price. So 100 times 1,000 shares, and you will get 100,000 as the market value of equity. So this is different from the book value.
So we assume that the other shareholders are the same.
Yes. Although they are not participating in the market, if they participate, we will assume that they will sell at the same price. All right, so now we compare the book value of equity and the market value of equity, and you will realize if you make a ratio between these two, often it is dramatically different. But in most of the cases, the market value is so large compared to the book value, so the ratio becomes 2, 7, and even 5 or 7. So it means the market participants, other people, are thinking that the company's value is much worthier than what is written in the financial statements. This is because generally because people are thinking about the future of the company. For example, Google will dominate the searching engine industry, and Coca-Cola will continue to be the number one seller for sodas, and also Delta Airlines will be one of the largest airline companies in the United States. So they are thinking that those companies' futures are bright, and at the same time they can maybe develop some technologies later, so that which will furthermore increase their value. So we need to be very careful, especially when we use the book value of an item, because actual market price can be different from the book value. Okay, and the second aspect in the value problem is that sometimes accountants are hesitating in recognizing some income. So, as I told you, accountants are very, very conservative, so they are trying to be very careful when they say, okay, our company earned something. So they only take care about the explicit revenues, something that we can directly see or something we can directly observe other than other things. And also they exclude, they removed only the explicitly written cost, and then they calculate their accounting income. So there are two problems. First, it does not reflect implicit revenues. So let's say you are running a company and you have a right to use a character, for example, Mickey Mouse from the Disney, and you were able to use the Mickey Mouse character for your product. So you made a collaboration between Disney and your company, and you sold something like some cups for the coffees with the character on it. And then the accountants will only consider your revenues as something what you can observe, which are the amount of money you earned by selling those cups. But on the other hand, we can actually think about other benefits. For example, we made a partnership between Disney, and now we are using a very popular character for our products. So maybe our products will be recognized to the customers, so that maybe in the future they will buy our products rather than purchasing others. And so those are the implicit revenues. We do not write on the financial statements. And at the same time, the next thing is that in following the accounting principle, we will not recognize implicit cost. For example, if I have, say, $1,000 today in my bank account, and I'm thinking about how to use this money. And my choice, let's say I chose to put those $1,000 in a savings deposit. And I will wait for 1 year, and then I will obtain the interest, say $400. This is too much. Let's say $40. So I earned $40 from the $1,000, and there was no explicit cost because I didn't lose any money that I had. But we actually lost something because you had $1,000 just 1 year ago, you were able to use it in other ways. For example, you were able to invest in stocks such as Samsung Electronics or Tesla, and then right now you will get more money from the investment. Or you were able to use it for the birthday present for your parents, and your parents will be happy, and maybe they can pay you back with other things. So these alternative choices that you didn't make, they are called opportunity cost because you chose the one thing and you lost the other options. So when you choose something, even though it seems that there is no explicit cost, you need to care about other options and other alternatives you had. So that is called as opportunity cost. So from an economics point of view, you need to care about not only the explicit cost, but at the same time, the opportunity cost as well. And then the economic income will be calculated as the total revenues, which include the explicit revenues and the implicit revenues together, minus opportunity cost, which is the maximum value that you had lost due to your choice. So that is economic income, and it is different from the accounting income. So overall, we learned about these two. Oh, so here's an example for a company. So this table is also from the textbook, and we are considering an imaginary firm. And from an accountant point of view, we can calculate our earnings like this. So we had operating income by selling some of our products, which is 821, and we had to pay for the debt we have, and also we had to pay for other expenses, and then the income before taxes were 7 and 10, and then we need to pay to the government, so we are paying taxes, which amounts 159, and then by deducting the taxes, we get the accounting earnings, which we often call net income. Net income will be 551. But on the other hand, this is not the economic. This is different from the economic income. So from the economist point of view, you are starting with the same situation. So you have made sales of $821, and you need to spend $97 and $14, and then before moving on, you need to think about yourselves. As a shareholder, as the owner of the company, you invested your cash to this company at the beginning. So by doing so, you have lost other chances of using your money in other ways. So that will be called as cost of equity. This is very difficult to precisely estimate the cost of equity, but we will just, for the matter of time, we will just assume that we eventually estimated that our cost of capital is $186, and then you need to take a minus, and then the income before taxes will be 524. But one interesting thing is that the government also does not know our cost of equity, so they will only rely on the financial statements. So the taxes are paid as the same as the previous one. So taxes are calculated based on the financial statements, so there's no difference in taxes in two cases. And then after deducting taxes, you will get the economic earnings, which is different from accounting earnings. And this economic income will be 365, which is lower than the accounting earnings because of our opportunity cost, which we call cost of equity.